Hello everyone. Welcome to our first online investment meeting in 2024. Please let me introduce myself. My name is Smith Tam, the portfolio manager of your asset. I have been managing the portfolio for 13 years. Our company has been providing portfolio management service over 20 years with 4 different investment strategies: aggressive, moderate, conservative, and life cycle. Here is the investment overview for our aggressive portfolios. We are holding fully and diversified equities exposure with overweight on developed markets. Currently, we have near two-thirds position in developed markets, which includes US and Europe, and high-quality sector that benefited from global recovery trend, such as technology, healthcare, and consumer discretionary. The other one-third positions involve regional Asia and selected emerging markets, in which Latin America is our favorite among emerging markets, increasing over 35% last year. Besides, we believe gold could be a long-term investment, given diversification purpose to portfolios and upside potentials on central banks turning towards easing this year. Here are our investment strategies and trading examples in 2022 and 2023. Fed hike and recession concerns trigger asset sell-off in almost all markets. Our portfolio decreased 20% in 2022. Although markets are not favorable for investors, we still can find some investment opportunities. We added exposure on Latin American and natural resources in 2022 amid higher commodity prices caused by Ukraine wars. Those positions successfully contribute gains to our portfolio after we bought. After a deep correction, markets started to rebound since Q4 last year, and this uptrend continued in 2023. Throughout the year, we believe global markets will be finally stabilized as economic indicators shows better than expected results during high inflation environment and wage hike cycle. We keep wait to see approach and maintain portfolios positions in first half of 2023 as we need more evidence to make sure global economy has enough resistance against tightening policies. Once confirmed, we adopt new investment strategy in Q4. We have reduced exposure in China and also top profits in natural resources. In turn, we switched into broader Asia, including India and ASEAN, Europe, and consumer discretionary sectors. As we believe that the next economic cycle will be driven by consumption from developed markets and Asia. Entering into 2024, although uncertainties remain, our base case is global recovery will reaccelerate amid easing policy in second half. Thus, we believe our portfolios could achieve higher return this year. As for performance, peaking out inflation and a resilient global economy push equities higher. Almost all our positions recorded positive return last year. Our portfolios gained around 10% for the year of 2023. Besides the Latin American rising over 35% as mentioned before, our core investment technology sector has rallied 50%. Those were the top performers within the portfolio. We expect the rebound would be continued this year amid growth driven by service sectors and expectation on rate cut in both US and Eurozone. Here we summarize our portfolio performance as well as strategy used during past crises. It's worth to note that our portfolios can always recover the losses after each crisis and reach new high again. For this time, we are confident to continue this trend of rebounding. In order to adapt new economic environment in coming months, we shift investment strategy to focus growth in service sectors. We believe that it could contribute more upside potential to us and the extent of gain to be larger than last year. That's our portfolio overview. Now we move to discuss the current strategy and market outlook. Let's talk about our current strategy first. 2024 looks set to be characterized by further cooling of inflation and the beginning of a rate easing cycle. Together with improved economic activities in Asia and Europe, those factors could help global growth continue the recovery trend, and less restrictive financial conditions will be generally supportive of stocks. We see positive US stock performance as an improving US inventory cycle boosts cyclical sectors. Moderate growth, cooling inflation, and wage cut should be generally supportive to US market in 2024. As for Europe, although growth is relatively lower than US, fiscal spending in Eurozone countries is currently far more supportive than it has been over the last decade. We think European stock valuation looks compelling with a 30% discount to US. In Asia, corporates are supported by robust balance sheets and lower debt levels. Regional countries are likely to enjoy a healthy growth differential relative to the developed markets in 2024. For fixed income, the trajectory of yield in developed markets, except Japan, is clearly downwards, given Fed prefers to dovish stand. Lower US Treasury yield and softer US dollar are expected, which could benefit Asian high-yield bonds. The central bank prefers, together with geopolitical uncertainties, also provide a key support for gold. We target gold prices will gradually approach $2,100 in 2024, but oil prices will be likely range-bound given the Middle East conflict will remain localized. Then we move to the market outlook on each region. There is a soft briefing for our opinions. After nearly 2 years of fighting inflation, 2024 outlook centers on the balance between growth with acceleration and stickiness of inflation. We anticipate that rate cut combined with falling inflation will start a new stage for recovery, accompanied by real wage growth in second half of 2024. We expect US GDP will be picking up again in the second half and growth at nearly 2% over the full year. Headline inflation continues moderating to close to the Fed target of 2% by year end, providing space for at least 3 times on rate cut. We stick to focus on names with earning resilience, such as technology and healthcare. In Europe, leading indicators such as confidence index and PMIs are turning positive. We believe outlook on Eurozone will gradually improve from peaking rate and bottoming out of economic activities. We expect broader Asia region can be follow the recovery in developed markets. South Asia, like India, is attractive for structural growth potentials, while the North, including Taiwan and Korea, benefits most from tech cyclical rebound. We also expect emerging markets to enter a positive backdrop in 2024, but divergences will persist. Countries such as Brazil offer the greatest opportunities amid economic reforms and strong potential for exports. But weak demand is likely to persist in China due to government deleveraging. As we move to 2024, we expect the global economy to slow marginally in the first half, resulting in a soft landing in major developed economies. However, the slowdown should be shortened by a turn to easing monetary policies. After that, growth could be reaccelerated again in the second half. We expect real wage growth to resume as inflation normalizes. It should further benefit consumption and service sectors, especially in developed markets, which we expect to become the main engines for global growth this year. Wage cut easing is surely the main theme for investors this year. We believe tightening cycle is nearly end with peak rate now. The first rate cut will begin in Q2, probably in May, as inflation continues to move towards acceptable level to tolerance the easing policies. Following the easing start, global economy could return towards trend growth in the second half. Historically, risk assets have performed better after the first rate cut compared to other periods, because easing policies helps increasing risk appetites for both institutional and individual investors. We believe US economy can successfully achieve soft landing in coming months, as surprisingly strong macroeconomic indicator and slowing inflation presented a picture of resilience. Firmer than expected retail sales data continue to be the spotlight, demonstrating resilience, consumer demand, and potential buffers built into household balance sheets. We think consumption growth will likely remain positive. Furthermore, the coming lower rate environment should be positive for growth stocks because lower borrowing costs helps boosting investment and expanding business. That's why we continue to focus in technology sectors, and it should be benefits most amid starting rate cut cycle. US S&P 500 index marked outperforming MSCI Europe by 11% in 2023. European equities are now trading at largest discount to the US equities in over 10 years. This discount is not just a story of sector composition, with this relative discount seems across all sectors. Within the developed market, we believe recovery in Europe should be followed by US. We expect to see some convergence between equity valuation this year, as Europe benefits from a continuous pool of excess savings and a sizable proportion of the EU Recovery Fund still to be disbursed. 65% of funds yet to be released into financial system starting from 2024 to stimulate regional economies and help supporting equity valuation. Most markets in Asia have successfully weathered the impact of the pandemic, with its effect largely dissipated. Given diminished inflation, nearly 80% of Asia region has already returned to the comfort zones set by central banks. We expect the interest rate tightening cycle is approaching its end, that Asian economy will return to a normalized growth path in 2024. As we are seeing the gradual shift from supply chains from China to South and Southeast Asia, India and Asian countries are gradually emerging as new manufacturing destinations. This could boost foreign direct investment and provide a solid foundation for economic expansion for those markets. Our Asian positions mainly involves India, Indonesia, and South Korea, with ESG characteristics that could able to achieve sustainable development. Although we are positive on equity market this year, there are still some uncertainties around us. One of the biggest risks is potential impact of the elections taking place around the world, including India, Indonesia, Russia, South Africa, UK, and US. Generally speaking, local asset markets would be more volatile ahead of the voting and perform more constructively once there is higher certainty about the future policy outlook. For example, Taiwan is just completed the election in January. There is no change in ruling party. We expect outlook for monetary policies and political climate will be maintained in future, supporting a stability in economy. In summary, we expect global economic growth to slow marginally with a soft landing in the first half. Following the disinflation process, policymakers will shift the stand from tightening to easing and begin to introduce rate cuts. Then global growth will start to reaccelerate in the second half, and risk assets should see renewed strength. This new round of growth cycle will be started from developed markets, followed by selected Asia or emerging market countries, such as India and Latin America. Technology and consumer will be the main growth drivers, and our portfolio have allocated positions into those regions and sectors. We expect 2024 will be a year that favors risky assets, such as equities, and upside potentials of portfolio will be higher than 2023. For yen, we think Bank of Japan will probably end its negative interest rates policy this year, and this could give some support to Japanese yen and prevent further depreciation in short term. However, rate differentials between US around 4 to 5% and Japan around 0 to 1% will remain large and will be maintained in long run. The previous ultra-low rate environment in US would not come back again. We expect Japanese yen will be remained at current rate level in near term and maintain our forecast for 150 to 160 yen per US dollar over medium to long term. That's the end of the presentation. Thank you for the listening, and I am looking forward to seeing you in Japan next year.